There is a phrase you have likely heard 1,000 times. A piece of financial dogma repeated so often it has become an unquestioned truth. Cash is trash. It is the mantra of the modern financial services industry, a simple, forward justification for a complex and often self-serving worldview. The idea is that every dollar you hold in cash is a lazy dollar. It is a soldier sitting in the barracks while the war for returns is being waged on the battlefield of the stock market. Every moment it sits there, it is being eroded by inflation, a silent thief stealing your future purchasing power. Every moment it sits there, it is missing out on the glorious compounding ascent of the market. To be anything less than fully invested, they say, is to be a fool, timidly watching from the sidelines as the brave and the bold conquer the future. It is a compelling narrative, one that preys on our fear of missing out, on our desire for action, on our deep-seated belief that progress must be constant and linear. And yet, there is a paradox at the heart of this dogma. A figure who looms so large over the world of investing that his every move is scrutinized, his every word parsed for meaning. Warren Buffett. The man who, by every conceivable metric, is the most successful investor in modern history. And this man, this icon of capital allocation, consistently and flagrantly violates the cash is trash rule. At any given time, his company, Berkshire Hathaway, might be sitting on $50 billion, $100 billion, even $150 billion of cold hard cash and its equivalents, like short-term treasury bills. This is not an accident, it is not an oversight, it is a deliberate core component of his entire investment strategy. While the rest of the world scrambles to stay fully invested, chasing the last few percentage points of a bull market, Buffett is patiently, methodically, building a mountain of ammunition. This raises a profound question. Is the entire financial world wrong, or is the greatest investor of all time making a colossal mistake? The answer reveals a deeper truth about money, risk, and opportunity. Buffett does not see cash as trash. He does not see it as a defensive, zero-return asset to be minimized at all costs. He sees it as something entirely different. He sees it as a strategic position that holds a unique and powerful asset, optionality. To Buffett, a massive cash position is not a sign of fear, it is a declaration of intent. It is a perpetual call option, with no expiration date and no strike price, on any bargain the world might foolishly offer him in the future. It is the ultimate offensive weapon, held in reserve for that rare moment when fear reaches a crescendo, when liquidity evaporates, and when once-in-a-generation buying opportunities present themselves to the very few who are prepared to act. This is not a story about saving money, it is a story about the strategic power of liquidity. It is a decoding of Buffett's most misunderstood and perhaps most important principle. It is an argument for transforming your own view of the most basic financial asset, moving from the amateur mindset that sees cash as a necessary evil to the professional framework that views it as the key to true financial resilience and the engine of extraordinary wealth creation. To understand why Buffett holds billions in cash is to understand the difference between simply playing the market and preparing to beat the market when it matters most. It is to learn that sometimes the most powerful move you can make is to do nothing, to wait, and to be ready. The first and most crucial step in understanding Warren Buffett's philosophy on cash is to reject the simple arithmetic of the spreadsheet and embrace the complex calculus of human psychology. For most of us, our relationship with cash is governed by a deep, primal fear, the fear of missing out. It is the quiet agony of watching a stock you almost bought double in price. It is the gnawing feeling that while your savings account earns a pittance, your neighbor is getting rich on the latest market fad. Cash, in this worldview, represents a tangible, measurable loss. You can calculate the exact opportunity cost. If the market returns 10% in a year and your cash returns 1%, the spreadsheet tells you that you have lost 9%. This is a painful, concrete number, and our brains are wired to despise such losses. But Buffett operates on a different psychological plane. He has inverted the equation. His primary fear is not the fear of missing out on incremental gains. It is the fear of missing out on a transformational opportunity. It is the fear of being unable to act when a true masterpiece of a business, a company he has admired for years, is suddenly offered at a ridiculously low price because the rest of the world is consumed by panic. This shift in perspective reframes the entire purpose of holding cash. It is no longer a passive, defensive position against loss. It becomes an active, offensive weapon of opportunity. It is the price you willingly pay for a ticket to the greatest sale on earth, a sale that happens only once or twice a decade. This is the essence of optionality. It is the power, but not the obligation, to make a decision. In finance, an option has a price. You pay a premium for the right to buy a stock at a certain price in the future. Buffett's cash is the premium he pays for the right to buy anything, any asset, at any time in the future when the price is right. And the best part? This option never expires. A story that perfectly encapsulates this mindset occurred in the immediate, terrifying aftermath of the September 11th attacks in 2001. The world was plunged into a state of profound uncertainty. The Twin Towers had fallen. The Pentagon was smoldering. For the first time in modern history, the entire United States airspace was shut down. The New York Stock Exchange was closed for 4 days, the longest closure since the Great Depression. When it finally reopened on September 17th, the scene was one of pure, unadulterated panic. The Dow Jones Industrial Average plunged over 7% in a single day, one of the largest point drops in its history. Pundits on television spoke in grave tones about the end of globalization, the dawn of a new era of terror and economic stagnation. Fear was the only commodity in abundant supply. For the average investor, the instinct was to sell everything, to flee to safety, to convert stocks into cash. But in Omaha, Nebraska, Warren Buffett was doing the opposite. He was sitting on a mountain of cash, and he was calm. He was not calm because he was naive to the gravity of the situation. He was calm because he was prepared. Years of disciplined capital allocation had left Berkshire Hathaway with immense liquidity. In a world where capital had suddenly become terrified and scarce, he was the ultimate source of financial security. While others were frantically calling their brokers to sell, Buffett was on the phone, but his calls were different. He was not selling. He was not even aggressively buying stocks in the open market just yet. He was simply available. He understood that in moments of extreme fear, the value of cash is not measured by the interest rate it earns, but by the power it confers. It conferred upon him the power to wait, to think rationally while others were panicking. It conferred upon him the psychological freedom from the desperate need to act. In the weeks that followed, as the initial shock subsided but a deep sense of unease lingered, Buffett began to deploy his capital. He did not rush. He did not try to catch the absolute bottom. He simply started buying shares in high-quality American businesses that he believed were now on sale. He saw the fear not as a reason to run, but as the source of a historic buying opportunity. He famously wrote an op-ed for the New York Times titled "Buy American, I Am," in which he stated his simple thesis: the long-term prospects of American businesses were not altered by the tragic events of that day. While others saw only risk and ruin, he saw resilience and value. This ability to be a net buyer of equities when the world is in chaos is a direct, undeniable consequence of his cash position. An investor who was fully invested on September 10th, no matter how brilliant, was powerless. They could only watch in horror as their portfolio value evaporated. They were a passenger on a crashing plane. Buffett, with his billions in cash, was in the control tower, ready to finance the recovery. This anecdote is not just about making money. It's about the profound psychological advantage that cash provides. It is the antidote to fear. It is the foundation of rational action in an irrational world. Holding cash allowed Buffett to separate his emotional response to a human tragedy from his analytical response to a market opportunity. a distinction that almost no one else could make in that moment. The psychological principle underpinning this entire philosophy is a well-documented phenomenon known as prospect theory, developed by Nobel laureates Daniel Kahneman and Amos Tversky. At its core, prospect theory describes how people make decisions under uncertainty, and it reveals a powerful, often irrational, asymmetry in our thinking. The key insight is this: the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This is the concept of loss aversion, and it is the hidden engine behind the cash is trash mantra. When an investor holds cash, they perceive the opportunity cost, the modest, steady gains of the market they are foregoing, as a series of small, guaranteed losses. Each day, each week, each month that the market goes up and their cash sits there, they experience a fresh pang of this loss. It's a slow, grinding pain. Our brains are not designed to withstand this. We crave action, we crave gains, and we desperately want to avoid the feeling of being left behind. This pressure creates what is known as an action bias, a tendency to act, to do something, anything, rather than to patiently wait. The financial media amplifies this bias, with its constant focus on daily market movements, hot stocks, and the need to put your money to work. The entire ecosystem is designed to make you feel foolish for holding cash. Buffett's genius lies in his ability to completely override this fundamental human wiring. He has successfully rewired his brain to invert the principles of prospect theory. For him, the potential pain of the big loss, missing a 2008-style opportunity to buy generational assets at pennies on the dollar, is far greater than the aggregated pain of the small losses from holding cash during a bull market. He has shifted his reference point. While the average person compares their cash balance to the soaring S&P 500 and feels regret, Buffett compares his cash balance to the immense, latent purchasing power it represents in a future crisis. He is not losing a few percentage points of upside. He is preserving the option to achieve decades of outperformance in a single year. This mental shift also shields him from a related cognitive trap, herd mentality. Human beings are social creatures, hardwired to seek safety in numbers. When everyone around us is fully invested and celebrating their portfolio gains, the pressure to conform is immense. To hold a large cash position is to stand apart from the herd, to invite ridicule and self-doubt. It is to be the person at the party who is not drinking. Buffett's long and successful track record has certainly helped him build immunity to this pressure, but the foundational defense is his unwavering internal scorecard. He judges his decisions not by whether they are popular or in line with the current consensus, but by whether they align with his own rigorously developed principles of value investing and risk management. Holding cash is a physical manifestation of this internal scorecard. It is a testament to his discipline and his willingness to look foolish in the short term to be brilliant in the long term. By understanding loss aversion and herd mentality, we can see that holding cash is not just a financial decision, it is an act of psychological rebellion. To translate this professional mindset into a practical tool, we can develop a mental model called the optionality filter. This is a three-step process designed to reframe your relationship with cash and build it into your personal investment strategy. The first step is purely psychological, but it is critically important. Reframe your cash. Go into your banking or brokerage app and change the name of your cash account. Do not call it savings or emergency fund. Those are defensive terms. Rename it the Strategic Opportunity Fund. This simple act of relabeling begins the process of changing your perception. It is no longer a pile of lazy money. It is a pool of disciplined capital waiting for a mission. It is your war chest. It is your dry powder. This fund is not for paying bills or fixing a leaky roof. Its sole purpose is to seize extraordinary investment opportunities. The second step is to quantify the value of this option. The main criticism of holding cash is its cost. So let's confront that directly. Ask yourself a simple question. What price am I willing to pay for the guaranteed right to deploy a significant amount of capital into the stock market after it has fallen by 40%? Would you pay 1% of your portfolio's value per year for that right? 2%? Let's say you decide to hold 15% of your portfolio in cash. In a year where the market returns 10%, your cash drag means your overall portfolio will return about 8.5%. Your opportunity cost, the price of your option, is 1.5%. For that 1.5%, you have purchased absolute peace of mind and the power to act decisively when others are paralyzed by fear. When viewed as the premium for a perpetual all-powerful call option, this cost seems laughably small. It is one of the cheapest and most valuable forms of insurance an investor can buy. The third and final step is what I call the sleep-at-night test. This is the key to calibrating the right cash position for your own risk tolerance and portfolio management style. Look at your portfolio and honestly imagine the market dropping 50% over the next 6 months. A 2008-level event. What is your gut emotional reaction? Is it a cold sweat, a knot in your stomach, a feeling of utter terror? If so, your cash position is too low. You are positioned to be a victim of a crash. Now, slowly increase your hypothetical cash allocation. 10%, 15%, 20%. Find the level where your emotional response fundamentally changes. Find the point where the thought of a 50% market crash shifts from being a terrifying catastrophe to a thrilling, once-in-a-decade opportunity, when your first thought is not, "Oh no, I'm ruined," but rather, "Finally, the sale I've been waiting for." You have found your correct cash position. For some, that might be 10%. For others, it might be 25%. The exact number is personal, but the feeling is universal. It is the feeling of being in control, of being the hunter and not the hunted. To truly appreciate the wisdom of this path, we must examine its opposite, the path of the 99%, the path of the fully invested gambler. This individual lives and breathes the cash is trash mantra. They view every dollar sitting in a savings account as a failure of imagination and courage. Their mindset is one of relentless optimization for returns. They are often intelligent, diligent, and highly engaged with the market. They read the financial news, they listen to the experts, and they are constantly seeking an edge. But their entire framework is built on a fragile assumption that the good times will keep rolling and that any downturns will be shallow and brief. The path of the fully invested gambler begins with a subtle form of leverage. They might not be borrowing money from a broker, but they are leveraged to the market itself. With 100% of their liquid net worth in equities, their financial fate is perfectly correlated with the whims of the market. In a bull market, this feels like genius. Their net worth climbs steadily, reinforcing their belief in the system. They might even start using actual leverage, margin loans, options, or leveraged ETFs to amplify their returns. Why let that extra borrowing capacity go to waste? This is the point where sound investment strategy bleeds into speculation. The psychological trap is that they begin to mistake the bull market's tailwind for their own skill. They believe they are brilliant stock pickers, when in reality, a rising tide is lifting all boats. Their overconfidence swells. They might start concentrating their bets, believing they have found the next Amazon or Google. Their portfolio, once diversified, becomes a high-stakes bet on a few trendy sectors. Then, the inevitable happens. The market turns. At first, they are not worried. It's a healthy correction, they tell themselves. Time to buy the dip. But they have no cash. To buy the dip, they must sell something else, or worse, borrow more. As the downturn deepens, their confidence begins to crack. The 20% correction becomes a 35% crash. Now, real fear sets in. If they have used leverage, they face the dreaded margin call. Their broker forces them to sell stocks at the worst possible time, locking in catastrophic losses to cover their loans. Even without explicit leverage, the psychological pressure becomes unbearable. Their entire net worth, their dreams of financial freedom, are evaporating before their eyes. They are powerless. They have no ammunition, They can only watch. Eventually, the pain becomes too much. The constant barrage of negative news, the sight of their portfolio value plummeting daily, it breaks them. They sell. They capitulate near the bottom, converting their shattered stock portfolio into cash at the point of maximum pessimism. They do this not as a strategic choice, but as an act of emotional surrender. The tragic irony is that they finally get to cash precisely when they should be fully invested, and they were fully invested precisely when they should have been holding cash. This is the disastrous consequence of ignoring Buffett's principle. It's a path that leads not to wealth, but to the cyclical destruction of capital. The financial connection between holding a strategic cash position and long-term wealth is not abstract, it is brutally mathematical. Let's illustrate this with a tale of two investors over a 20-year period that includes a major market boom and bust. Investor A is the fully invested dogmatist. She starts with $100,000 and invests it all in an S&P 500 index fund. For 20 years, she diligently stays the course. Investor B is the Buffett apprentice. She also starts with $100,000, but she follows a simple rule. She keeps 20% of her portfolio in cash, earning a nominal interest rate, and 80% in the S&P 500. For the first several years, during a raging bull market, Investor A appears to be the clear winner. If the market returns 15% a year, her portfolio grows by 15%. Investor B's portfolio, with its 20% cash drag, only grows by about 12%. Investor A smirks, confident in her strategy. After 10 years of a bull market, her initial $100,000 has grown substantially more than Investor B's. But then, the crash comes. The market falls 50% over the course of a year. Investor A's portfolio is cut in half. A $500,000 portfolio becomes $250,000. The pain is immense. Investor B's portfolio also falls, but not by as much. Since only 80% of her portfolio was in stocks, her total portfolio value only drops by 40%. Her $500,000 becomes $300,000. She has already preserved $50,000 of capital relative to Investor A, simply by holding cash. But this is where the real magic happens. Now, with the market at its bottom, Investor B executes the second part of her strategy. She deploys her strategic opportunity fund. She takes her cash, which has held its value, and reinvests it into the stock market at these new, deeply depressed prices. This single act of capital allocation dramatically increases her ownership stake in American businesses. When the market inevitably recovers, the effect of this move is explosive. As the market climbs back to its previous highs, Investor A's portfolio simply recovers to its old level. She has spent years just getting back to even. But Investor B's portfolio, supercharged by the infusion of cash at the bottom, rockets past its old highs. When all is said and done, after the full 20-year cycle of boom and bust, Investor B's final portfolio value is significantly, often shockingly, higher than Investor A's. The years of modest underperformance during the bull market are rendered utterly insignificant by the 1 or 2 years of massive outperformance during and after the crash. This is the direct, quantifiable financial power of optionality. It is how you stop playing for average returns and start executing a strategy for beating the market. The central pillar supporting the entire cash is trash argument is the dogma of being fully invested at all times. This idea is often justified by another well-known and generally wise piece of advice. It's about time in the market, not timing the market. The logic is that since no one can perfectly predict the market's tops and bottoms, the best strategy is to simply stay invested through thick and thin, capturing the market's long-term upward trend. While the principle is sound, its application by the financial industry has become a dangerous absolute. It has been twisted into a justification for permanent, unthinking exposure to risk, regardless of price or valuation. This fallacy of the fully invested mandate is one of the most reliable ways for investors to experience mediocre returns and expose themselves to catastrophic losses. Buffett's approach is not about timing the market, but about what he calls weighing the market. He doesn't try to predict when it will rain. He simply looks out the window, and if the sky is full of dark clouds, he brings an umbrella. A large cash position is his umbrella in a market environment forecasting a storm of overvaluation. Perhaps no period in Buffett's career illustrates his defiance of the fully invested fallacy more profoundly than the dot-com bubble of the late 1990s. It was a time of pure speculative mania, a new era where the old rules of business and valuation were declared obsolete. Companies with no profits, no revenues, and often no viable business plan were going public and achieving market capitalizations in the billions of dollars. The Nasdaq index was soaring, doubling and then doubling again. Everyone was getting rich. From taxi drivers to dentists, it seemed the whole country was day trading technology stocks. And in the middle of this national party, Warren Buffett and Berkshire Hathaway were sitting it out. He famously refused to buy the high-flying tech stocks. He admitted he didn't understand their business models or how to value them. Berkshire's portfolio was full of old economy companies like Coca-Cola, Gillette, and See's Candies. The market's judgment was swift and brutal. Buffett was mercilessly ridiculed. Cover stories in major financial magazines declared him a relic, a dinosaur whose folksy, value-based approach was hopelessly out of touch with the new digital paradigm. In 1999, as the Nasdaq soared 85%, Berkshire Hathaway's stock actually fell by 20%, an astonishing 105-point divergence. Imagine the psychological pressure. Your shareholders are losing money while the rest of the world is having the party of a lifetime. You are being openly mocked as a has-been. The temptation to capitulate to just buy a handful of tech stocks to get in the game must have been immense. But Buffett did not budge. He let his cash position grow. He was a net seller of stocks in a market that seemed to only go up, a clear violation of the fully invested rule. He patiently endured the pain of underperformance, secure in his conviction that paying insane prices for speculative businesses was a fool's game. Then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a sickening two-year collapse that would erase nearly 80% of its value. Trillions of dollars of phantom wealth vanished into thin air. The new era darlings went bankrupt. The day traders were wiped out. The pundits who had celebrated the mania fell silent, and Warren Buffett, the dinosaur, was proven to be the wisest man in the room. His cash hoard, which had been a source of ridicule, was now a symbol of his genius and discipline. It had not only protected Berkshire from the carnage, but had also positioned him to take advantage of the aftermath. While the rest of the investment world was nursing catastrophic losses and trying to recover, Buffett was on the hunt, using his capital to buy good businesses at fair prices. This anecdote is the ultimate case study in the perils of permanent exposure. It demonstrates that there are times when the single best investment decision you can make is to refuse to play a rigged game. Staying fully invested during a speculative mania is not a strategy, it is a surrender to madness. The psychological forces that drive the fully invested fallacy are among the most powerful in the human behavioral toolkit. Chief among them are herd mentality and its close cousin, FOMO, the fear of missing out. As social creatures, we are deeply programmed to find safety and validation in the actions of the group. When our friends, neighbors, and colleagues are all talking about how much money they are making in the stock market, our brains interpret this as social proof that being in the market is the correct and safe thing to do. The rising market itself becomes a self-fulfilling prophecy. As more people buy, prices go up, which in turn provides more social proof, attracting even more buyers. This feedback loop is the engine of every financial bubble in history. FOMO is the emotional fuel for this engine. It is a deeply uncomfortable cocktail of envy, anxiety, and regret. It is the voice in your head that whispers, "Everyone else is getting rich, and you are being left behind. You are a fool for being so cautious. You have to get in now before it's too late." This feeling is so powerful that it can cause people to abandon decades of prudent financial habits. It can make a conservative saver suddenly pour their life savings into a speculative cryptocurrency or a profitless tech stock at its all-time high. It overrides our rational, analytical brain. the part that might question valuations or business fundamentals, and puts our emotional, impulsive brain in the driver's seat. The financial industry, whether intentionally or not, is perfectly designed to exploit these biases. The 24/7 news cycle, with its breathless reporting on daily market moves, creates a sense of urgency and constant activity. The league tables showing top-performing funds create a powerful sense of FOMO. Financial advisors, often compensated based on assets under management, are incentivized to keep their clients as fully invested as possible. The very phrase "put your money to work" implies that cash is idle and unproductive, reinforcing the action bias. Buffett's ability to resist these forces is legendary. It stems from his unshakable focus on a company's intrinsic value. He is not buying a stock ticker, he is buying a piece of a business. If the price of that business is irrational, he simply will not buy it, no matter how much fun the rest of the herd is having. His cash position is therefore not a market timing tool, but a discipline tool. It is the physical result of his refusal to participate in speculative behavior driven by herd mentality and FOMO. It is his shield against the madness of crowds. To counter the powerful urge to stay fully invested at all times, you need a rational, systematic mental model for assessing market risk. You need a way to weigh the market, not time it. Let's call this model the overvaluation indicator. It is not a perfect, foolproof system for predicting crashes, but rather a dashboard of indicators that can tell you when market risk is historically high, signaling that it is a prudent time to be trimming positions and building your strategic opportunity fund. The first component of this model is the most famous one, the Buffett indicator itself. This is the ratio of the total market capitalization of all U.S. stocks to the country's gross domestic product, GDP. Buffett has called it probably the best single measure of where valuations stand at any given moment. Historically, when this ratio is in the range of 70 to 80%, stocks are considered cheap. When it rises above 100%, they are considered fairly valued. But when it starts to climb towards 150, 200% or even higher, as it did during the dot-com bubble and in more recent years, it is a flashing red light that the market is significantly overvalued relative to the underlying economy. You don't need to sell everything when the indicator is high, but it should certainly give you pause before deploying new capital and encourage you to trim your biggest winners. The second component is the Shiller P/E ratio, also known as the cyclically adjusted price-to-earnings CAPE ratio. Instead of looking at just 1 year of earnings, which can be volatile, the CAPE ratio uses the average of the last 10 years of inflation-adjusted earnings. This provides a much smoother and more reliable measure of a company's or the market's earning power. Like the Buffett indicator, the Shiller P/E has a long historical track record. When it is significantly above its long-term average, it has historically been followed by periods of subpar or even negative returns over the subsequent decade. When you see both the Buffett indicator and the Shiller P/E at levels seen only a few times in the last century, it is a powerful signal that future returns are likely to be low, and the risk of a significant drawdown is high. The third and perhaps most accessible component is the personal circle analysis. This is a qualitative, anecdotal indicator. It's the moment when you start getting unsolicited stock tips from people who have never shown an interest in investing before. Your dentist, your brother-in-law, a rideshare driver. It's when financial news moves from the business section to the front page and becomes a staple of casual conversation. When speculation becomes a national pastime, it is an almost infallible sign that a market top is near. This model, combining the Buffett indicator, the Shiller P/E, and personal circle analysis, doesn't tell you to sell everything and go to cash. It tells you to be cautious. It gives you permission to ignore FOMO. It provides a rational basis for building your cash position, not because you are timing the market, but because you are intelligently managing risk in the face of obvious, historically significant overvaluation. Now let us examine the antithesis, the time in the market dogmatist. This person is not necessarily a reckless gambler, but rather a true believer in a simplified version of a sound principle. They have correctly understood that trying to dance in and out of the market is a loser's game. So, they adopt a strategy of dollar-cost averaging and staying invested no matter what. They are admirable in their discipline and their long-term focus. However, they turn this sound principle into a dangerous dogma by ignoring the crucial variable of valuation. The dogmatist continues to plow their savings into the market every month, regardless of whether the Buffett indicator is at 70% or 200%. They see their role as a passive allocator, not an active risk manager. Their belief system doesn't allow for the possibility that there are times when it is prudent to pause. They view a 2008-style crash not as a somewhat predictable consequence of extreme leverage and overvaluation, but as a random, unforeseeable black swan event, an act of God that one must simply endure. When the crash comes, their powerful discipline might prevent them from panic selling at the bottom, which is commendable. They will likely hold on and eventually recover. But the damage to their long-term financial goals is immense. A 50% drawdown requires a 100% gain just to get back to even. It can take 5, 7, or even 10 years for their portfolio to reclaim its previous peak. That is a decade of lost time, a decade of zero real returns. This lost decade can be devastating for someone approaching retirement or trying to build wealth for a specific goal. They may have avoided the emotional mistake of selling at the bottom, but they made the critical strategic mistake of being fully exposed to the crash in the first place. They fail to understand a key asymmetry of investing. Avoiding large losses is more powerful than capturing all the upside. A portfolio that captures 80% of the market's upside, but only 50% of its downside, will massively outperform a fully invested portfolio over the long run. The dogmatist, in their noble quest to avoid the sin of market timing, commits the greater sin of ignoring risk. They confuse activity with progress and mistake permanent exposure for a sound investment strategy. Their portfolio survives, but it does not thrive. They are playing a game of simple accumulation, while Buffett is playing a game of strategic capital allocation, which includes the intelligent and disciplined use of a cash position as a risk management tool. The direct financial connection here can be visualized by comparing the long-term wealth journeys of these two different approaches. Imagine a chart tracking the net worth of two investors from the year 1995 to 2015, a period that includes the massive dot-com boom, the devastating bust of 2000 to 2002, the recovery, and the global financial crisis of 2008. Investor A, the time-in-the-market dogmatist, puts their money into an S&P 500 fund and never wavers. Their chart soars in the late 90s, reaching a dizzying peak in early 2000. Then it falls off a cliff, losing nearly half its value by 2002. It then begins a slow, arduous climb back, finally surpassing its 2000 peak in 2007, only to be crushed again in the 2008 crisis. By 2010, after 15 years of diligent investing, their portfolio is roughly back to where it was a decade earlier. Now look at the chart for Investor B, the Buffett apprentice. She follows a simple asset allocation rule based on the overvaluation indicator. When the market is fairly valued, she is 80% in stocks and 20% in cash. As the dot-com bubble inflates and valuations become extreme in 1998 and 1999, she trims her stock positions and raises her cash allocation to 40%. Her chart doesn't reach the same insane peak as Investor A's, and she feels the sting of underperformance. But when the crash comes, her portfolio's decline is far shallower. The 40% cash position acts as a powerful buffer. Then, in late 2002, with valuations back at reasonable levels, she redeploys her cash back into the market. Her chart begins a powerful ascent. When the 2008 crisis hits, she again has a cash buffer that cushions the blow, and she once more redeploys it near the bottom. The end result is not even close. Over the full 20-year period, Investor B's final net worth is dramatically higher than Investor A's. Her path was less volatile. She experienced shallower drawdowns, and she ultimately achieved a far superior result. This is the tangible financial power of strategic portfolio management. Avoiding the full fury of the bear market is the single most effective way to ensure you are compounding your wealth at the highest possible rate over the long term. Understanding the psychology of cash and the fallacy of being fully invested is the foundation. But the critical next step is the practical application. How does one actually build and manage a cash position? This is not a matter of guesswork or gut feeling. It is a discipline, an art, and a science of capital allocation that requires patience, a clear framework, and the emotional fortitude to resist the constant temptation to deploy capital prematurely. For Buffett, building cash is not an active decision to go to cash. He rarely, if ever, sells a wonderful business just because he thinks the market is too high. Rather, his cash position builds up naturally, almost passively, as a byproduct of his unwavering investment discipline. When he cannot find any new opportunities, stocks, bonds, or whole companies that meet his strict criteria of a wonderful business at a fair price, the cash simply piles up. It is the residue of his patience. A perfect illustration of this process occurred in the years leading up to the 2008 global financial crisis. From roughly 2005 to mid-2007, the global economy was booming. Credit was cheap, animal spirits were running high, and asset prices were soaring. It was a seller's market. Companies were being acquired at huge premiums, and private equity firms were using massive amounts of debt to take companies private at eye-watering valuations. During this period, Buffett found himself with a peculiar problem. He had too much money and not enough to do with it. Berkshire's businesses were generating billions of dollars in free cash flow every quarter, and he couldn't find anything to buy that wasn't, in his view, ridiculously overpriced. He looked at hundreds of potential deals and passed on almost all of them. As a result, Berkshire Hathaway's cash hoard swelled. It grew from around $20 billion to over $45 billion by the end of 2007. He wasn't timing the market. He wasn't making a grand prediction that a housing crisis was about to cripple the global financial system. He was simply practicing his craft with integrity. He was a shopper in a world of outrageously expensive merchandise, and he chose not to buy. In his 2007 letter to shareholders, written just before the crisis began in earnest, he complained about this very problem, writing, "We have the money, but we don't have the ideas. That's no disaster. At Berkshire, we will stick with our approach of buying good businesses at sensible prices. This policy has served us well, and it will continue to do so." This quote is incredibly revealing. He saw his massive cash position not as a brilliant strategic coup, but as a frustrating consequence of a frothy market. Yet this disciplined inaction was precisely what armed him for the coming storm. When the crisis hit and assets went from being overpriced to being on a fire sale, he was one of the only people on earth with both the capital and the courage to act. His cash built up not because of a forecast, but as a result of discipline. The psychological barrier that prevents most investors from building a cash position, even when they know they should, is a pair of powerful cognitive biases: the endowment effect and status quo bias. The endowment effect, first described by economist Richard Thaler, is our tendency to irrationally overvalue something simply because we own it. A stock you own, in your mind, is somehow better, safer, and has more potential than a stock you don't own. This makes it incredibly difficult to sell, even when its price has become detached from its underlying value. You've been on a journey with this company, you've watched it grow, and selling it feels like a betrayal or the admission of a mistake. Status quo bias is the preference for things to stay the same. Making a change, like selling a long-held stock to raise cash, requires effort and introduces uncertainty. It is often easier and more psychologically comfortable to do nothing, to stick with the current portfolio, even if the rational choice would be to make a change. A classic test for this bias is to ask yourself, if I didn't already own this stock, would I buy it today at its current price? If the answer is no, or even a hesitant maybe, then your decision to continue holding it is likely being driven by status quo bias. not by a rational assessment of its future prospects. These two biases work together to create a state of portfolio inertia. Investors' portfolios become museums of past decisions rather than optimized tools for future returns. They become overweight in the high-flying stocks of the last bull market, the very assets that are most vulnerable to a correction. The idea of selling a portion of that beloved tech stock that has quintupled in value to raise cash feels viscerally wrong. It's your biggest winner. The endowment effect makes you overvalue it, and status quo bias makes the act of selling it feel like an unnatural and risky move. Buffett overcomes this by being ruthlessly unsentimental about his investments. He views stocks not as cherished possessions but as pieces of a business that have a specific intrinsic value. If the market price rises far above that value, he is happy to sell it to someone more optimistic and convert his holding back into the flexible potential of cash. To overcome these biases and systematically build a cash position, we can employ a mental model called the disciplined gardener's trim. A good gardener knows that to foster healthy long-term growth, you must occasionally prune the plants that have grown too large, even if they are beautiful. This allows sunlight to reach the smaller plants and maintains the overall health of the garden. Your portfolio is the same. This model provides a systematic, unemotional process for pruning. Step 1 is to set your wish list price in advance. For every significant stock position you own, take the time now, while you are calm and rational, to determine the price at which you believe it would be clearly overvalued. This is not the price at which you think it's a hold, but the price that would make you say, "This is fantastic," but the valuation has gotten ahead of itself. Write this price down. This act of pre-commitment is crucial, as it makes the future decision for you, taking emotion out of the equation. Step 2 is to create an automatic trim rule. This rule could be, for example, if any stock in my portfolio hits its predetermined wish list price, I will automatically sell 25% of my position. No second guessing, no waiting to see if it goes even higher. The rule is the rule. This forces you to take profits from your biggest winners and converts those paper gains into tangible cash for your strategic opportunity fund. It is a systematic way to rebalance your portfolio away from the assets that have become the most expensive and riskiest. It is the perfect antidote to the endowment effect, as the decision is no longer a painful discretionary choice but the simple execution of a pre-existing plan. Step 3 is to regularly apply the opportunity cost test. At least once a quarter, go through your portfolio and ask that critical question for each holding. If my entire portfolio were in cash today, would I enthusiastically buy this stock at its current price? Be brutally honest with your answer. If the answer is a resounding yes, then it deserves its place in your portfolio. But if the answer is no, or I'm not sure, you have identified a candidate for trimming. This question powerfully counters status quo bias by forcing you to re-justify every position as a new purchase. This disciplined process of setting prices, following rules, and testing for opportunity cost is how you shift from being a passive holder of stocks to an active manager of capital, intelligently building your cash position when the market gives you the gift of overvaluation. The antithesis of this disciplined approach is the emotional accumulator. This is the investor who falls in love with their stocks. They see themselves not just as an owner of a business, but as a fan, a believer. Their identity becomes intertwined with the success of the companies they own. For them, selling is an act of disloyalty. They tell themselves stories about never selling a winner, and quote, a distorted version of Buffett's "our favorite holding period is forever." They forget that Buffett has sold plenty of stocks over the years when the situation changed or the price became too high. The emotional accumulator's portfolio inevitably becomes a reflection of the past, not a strategy for the future. It becomes dangerously concentrated in a handful of companies that performed spectacularly in the last bull market. They might have 50 or 60% of their net worth tied up in a single tech stock. They rationalize this lack of diversification by saying, "You don't get rich by diversifying." They ignore the fundamental principles of risk management. They also often have an aversion to paying taxes. viewing the capital gains tax as a penalty to be avoided at all costs. They would rather risk losing 50% of their principal in a crash than pay a 20% tax on their gains. This is a classic case of the tail wagging the dog, where a secondary consideration, taxes, dictates a primary investment decision, leading to a disastrously risky portfolio structure. When the market finally turns, the emotional accumulator is completely exposed. The very stocks that made them feel like a genius are the ones that fall the hardest. Their concentration, which created so much wealth on the way up, now destroys it with breathtaking speed on the way down. Because they never trimmed, they have no cash. They are powerless to take advantage of the new opportunities that emerge. They can only hold on, their emotions swinging from pride to fear to despair, as their paper fortune evaporates. Their failure is not one of intelligence, but of process. They lacked a systematic, unemotional framework for capital allocation, and instead allowed love, loyalty, and tax aversion to dictate their investment strategy, a recipe for ultimate disappointment. The direct financial connection of a disciplined cash-building strategy is immediately visible on a balance sheet, whether it's for a corporation like Berkshire Hathaway or for an individual. A balance sheet has two sides: assets and liabilities. The strength and resilience of any financial entity is determined by the quality and structure of these two sides. Cash and cash equivalents, like treasury bills, are the highest quality, most liquid assets you can own. They are the bedrock of financial security. For a business, a healthy cash position improves key financial ratios that lenders and investors look at. For instance, the current ratio, current assets divided by current liabilities, is a primary measure of a company's ability to meet its short-term obligations. A company with a huge pile of cash has a very strong current ratio, signaling to the world that it is in no danger of default. This financial strength translates into a higher credit rating, which in turn means a lower cost of borrowing. This becomes a powerful competitive advantage. A company with a fortress balance sheet can borrow more cheaply than its rivals, allowing it to invest in growth or survive a downturn more easily. For an individual, the concept is the same. Think of your personal net worth statement as a balance sheet. Your assets are your home, your investments, your savings. Your liabilities are your mortgage, your car loan, your credit card debt. Having a significant portion of your assets in a strategic opportunity fund dramatically improves your personal financial resilience. If you lose your job or face an unexpected major expense, you are not forced to sell your stocks at an inopportune time or go into high-interest debt. You have a buffer. This financial security is not just a feeling, it is a measurable state of anti-fragility. It ensures that a shock to your income statement, your job, does not have to become a catastrophe for your balance sheet, your net worth. It is the financial foundation that allows you to take calculated risks in other areas of your life and to sleep soundly at night, knowing you are prepared for whatever the economy might throw at you. Having prepared the ammunition is only half the battle. The entire purpose of building a strategic cash position is to eventually deploy it. This is the moment of truth, the climax of the value investor's journey, the hunt for and execution of once-in-a-decade buying opportunities. This is where patience is rewarded and where fortunes are truly made. It is the phase where cash is transformed from a dormant asset into an incredibly powerful offensive weapon. And there is no greater example of this in modern financial history than Warren Buffett's performance during the 2008 global financial crisis. He did not just buy stocks, he became the lender of last resort to the entire capitalist system, dictating terms that were almost unbelievably favorable, all because he was the only one with the cash and the credibility to do so. The story begins in September 2008, the darkest month of the crisis. Lehman Brothers, a 158-year-old investment bank, had just filed for the largest bankruptcy in U.S. history. The global credit markets were frozen solid. Banks refused to lend to each other, terrified of who might be next to fail. The entire financial system was on the brink of collapse. Panic was absolute. In this environment of pure terror, Buffett's phone in Omaha started ringing. On one end of the line were the titans of American finance, men who just months earlier had been considered masters of the universe. Now, their firms were bleeding cash, their stock prices were in freefall, and they were desperate for a lifeline. They didn't call the government first, they called Warren Buffett. His reputation for integrity and Berkshire's fortress balance sheet made him the only credible source of private capital in the world. On September 23, 2008, with the fate of the global financial system hanging in the balance, Buffett struck a deal to invest $5 billion in Goldman Sachs, the most prestigious investment bank on Wall Street. But he didn't just buy their common stock. The terms he negotiated were breathtaking. He received $5 billion worth of preferred stock that paid him a 10% annual dividend. That's a guaranteed $500 million in cash flow every year, at a time when interest rates on government bonds were heading towards zero. But that was not all. He also received warrants that gave him the right to buy $5 billion worth of Goldman's common stock at a fixed price of $115 per share any time over the next 5 years. Goldman's stock was trading at around $125 at the time, so the warrants were already valuable, but their true power was the 5 years of upside they represented. Just over a week later, he did it again. He struck a similar deal with General Electric, a cornerstone of the American industrial economy, which was struggling due to its large financial arm. He invested $3 billion in GE preferred stock, also with a 10% dividend, and also received warrants. These were not deals available to the average investor. This was a master capital allocator using his two most valuable assets, his cash and his reputation, to secure terms that were almost criminally profitable. He was not bottom fishing in the stock market. He was providing rescue financing at a time of maximum distress, and he was being compensated handsomely for the risk he was taking and the stability he was providing. This is the ultimate expression of the market crash strategy. It's about more than just buying low. It's about positioning yourself to be the one everyone turns to when the world is falling apart. The psychological forces at play during a market crash are the exact inverse of those during a bubble, but they are even more powerful. The primary driver is a phenomenon known as the availability cascade. During a crash, the media is saturated with stories of financial ruin, bankruptcy, and economic collapse. Every news channel, every newspaper, every website is screaming about the crisis. This relentless barrage of negative information makes the worst-case scenarios seem not only possible but highly probable. Our brains, using the availability heuristic, judge the likelihood of an event by how easily we can recall examples of it. When every example we see is negative, our perception of reality becomes dramatically skewed towards disaster. We lose all perspective. This cascade fuels a raw, primal fear contagion. Fear is more infectious than greed. It spreads from person to person, through conversations, news reports, and plunging stock tickers. It creates a feedback loop of panic selling. As prices fall, more people panic and sell, which drives prices even lower, causing even more panic. It is a vortex of negative emotion that is almost impossible for the average person to escape. This is why most people fail at investing. They are psychologically incapable of being greedy when others are fearful. Their instincts scream at them to run for the hills with the rest of the herd. So how does Buffett remain rational in the face of this overwhelming psychological onslaught? His primary defense is preparation. His actions during the 2008 crisis were not impulsive. They were the execution of a lifelong strategy. He has spent decades studying businesses. He has a deep, ingrained understanding of their long-term earning power and intrinsic value. His massive cash position acts as a psychological firewall. Because he is not in danger of being wiped out, he is not personally afraid. This lack of personal fear allows his rational brain to remain in control. He can dispassionately analyze the situation and recognize that while the fear is real, the prices it has produced are irrational. He is not immune to the news, but he filters it through a lifetime of experience and a rigid analytical framework. The cash provides the emotional distance needed to make brilliant decisions while everyone else is losing their minds. To operationalize this level of preparedness, you can create a mental model I call the emergency shopping list. This is a concrete plan you create during times of market calm that you can execute automatically during a time of crisis. It is your instruction manual for acting rationally when your instincts are screaming at you to panic. The process has 3 steps. First, you must curate your dream team of businesses. These are not speculative stocks. They are world-class companies that you would be thrilled to own a piece of for the next 20 years. Think of companies with unbreachable competitive moats, like a dominant brand, a network effect, or a low-cost production advantage. They should have pristine balance sheets with low debt and a long history of consistent profitability and shareholder-friendly management. You should spend time really getting to know these 10 to 15 companies. Read their annual reports, understand how they make money. Become an expert on this small universe of elite businesses. Second, for each company on your dream team, you must calculate your no-brainer price. This is the price at which, given your deep understanding of the business, buying its stock would be an absolute steal. This is not a guess about where the stock might bottom out. It is a carefully calculated price that provides you with a significant, quote, margin of safety, in the words of Buffett's mentor Benjamin Graham. It is a price so attractive that it offers a huge upside potential with very little long-term risk. Write these prices down next to the company names on your shopping list. Third, and most importantly, you must commit to action. The plan is worthless if you don't execute it. When the next market crash inevitably arrives, you do not need to think, you do not need to analyze the news, you do not need to ask for anyone's opinion. Your only job is to pull out your emergency shopping list and see if any of your dream team companies have hit their no-brainer price. If they have, you buy. You deploy a portion of your strategic opportunity fund. You can even set limit orders in advance with your broker. The decision was already made months or years earlier, when you were in a calm, rational state of mind. This model removes emotion from the executive decision-making process at the very moment when emotion is your greatest enemy. It is the key to transforming fear from a paralyzing force into the trigger for disciplined, wealth-creating action. The antithesis to this planned, strategic approach is the panic-stricken bottom fisher. This investor has no plan. They have likely heard the phrase, "be greedy when others are fearful," but they have no framework for applying it. When the market starts to fall, their first reaction is the same as everyone else's: fear. They watch their portfolio decline and feel the same knot in their stomach. But then, after the market has fallen, say 30%, their greed instinct kicks in. They see stocks that were once expensive now looking cheap. They think, this must be the bottom, it's time to be a hero. But they have no shopping list, they have no pre-calculated prices. So what do they buy? They are drawn to the stocks that have fallen the most, the ones that are down 70, 80, or even 90%. They are trying to catch a falling knife, hoping for a quick, multi-bagger return on a bounce. They might buy a speculative tech company, a highly leveraged bank, or an airline on the brink of bankruptcy. They are buying based on the size of the price drop, not on the quality of the underlying business. This is not value investing. It is a form of gambling. Because they have no deep conviction in what they are buying, their courage is brittle. When the stock they just bought drops another 20%, as it often does in a bear market, they are immediately plunged into a state of panic and regret. I was wrong. It's going to zero. They sell the position, locking in a quick and painful loss. They are whipsawed by the market's volatility, buying on greed and selling on fear. They are reacting to the noise and the price action, not executing a coherent investment strategy. In the end, they often suffer worse losses than those who simply held on, because they managed to crystallize their losses at the worst possible times. Their failure is a failure of preparation. The direct financial connection of Buffett's 2008 masterstroke is staggering and serves as the ultimate proof of this entire philosophy. Let's quantify the Goldman Sachs deal. Berkshire invested $5 billion. In return, they received $500 million in dividends each year. By 2011, Goldman had recovered and bought back the preferred stock from Berkshire, paying a 10% premium to do so. So for an investment of less than 3 years, Berkshire received about $1.7 billion in dividends and premiums. But the real prize was the warrants. As Goldman's stock price soared in the market recovery, the value of those warrants exploded. In 2013, Buffett exercised them. Instead of paying cash, he did a, quote, cashless exercise that resulted in Berkshire receiving shares of Goldman stock worth over $2 billion. All told, on a $5 billion investment, Berkshire Hathaway made a profit of well over $3 billion in less than 5 years. This one single deal, made possible only by having a mountain of cash and the courage to act during a panic, generated more profit for Berkshire than decades of patient compounding in many of its smaller investments. It fundamentally altered the company's financial trajectory. This is the ultimate goal of wealth management. It is not about grinding out an extra 0.5% of return each year. It is about structuring your portfolio and your mindset in such a way that you can make these kinds of transformative moves once or twice in your investment lifetime. It shows how a cash position, which appears as a drag on returns year after year, is actually the seed corn for the massive, non-linear gains that truly define long-term market-beating success. The final pillar of Buffett's cash philosophy transcends the realm of stock market tactics and enters the domain of grand corporate strategy and permanent financial resilience. Holding billions in cash is not just about preparing for the next market crash. It is a fundamental component of Berkshire Hathaway's corporate identity. It is what makes the company a fortress, a financial entity designed to withstand any economic storm and to last for centuries. This perspective elevates the conversation from simply managing a portfolio to building an enduring institution, a concept that is just as relevant for an individual striving for true financial security as it is for a megacorporation. Cash, in this final analysis, is the ultimate tool for achieving a state of anti-fragility, a state where shocks and crises not only don't harm you, but actually make you stronger. The foundational anecdote for this concept lies not in a single transaction but in the very structure of Berkshire Hathaway's core business, insurance. To understand Berkshire, you must understand insurance. And to understand insurance, you must understand float. When you pay your premium to an insurance company, like Berkshire's subsidiary Geico, the company gets to hold your money for a period of time before it has to pay out any claims. This pool of money, premiums collected but not yet paid out in losses, is called float. For most insurance companies, the goal is to break even on the underwriting, premiums and equal claims and expenses paid out, and make their profit by investing the float. Buffett, through his legendary discipline, has consistently managed to run his insurance operations at an underwriting profit, meaning customers are effectively paying Berkshire to hold their money. This creates a massive, permanent, and cost-free, or better than cost-free, pool of capital that Buffett can then invest for the long term. At any given time, Berkshire's float can be in the tens or even hundreds of billions of dollars. This is the engine at the heart of the Berkshire Fortress. It is a structural cash-generating machine. This constant influx of cash from the insurance operations, combined with the profits from Berkshire's wholly owned businesses, means that the company's cash pile is always being replenished. This structural advantage is what gives Buffett the unparalleled freedom to wait, for years if necessary, for the perfect pitch. He is never forced to invest. He is never under pressure to generate short-term returns. He can operate on a time horizon that is radically different from almost any other money manager. This concept of building a float or a permanent capital structure is the ultimate expression of financial resilience. It's not just about having savings. It's about designing a system that is inherently cash-generative and robust. The psychological principles that Buffett's long-term fortress mentality helps him overcome are subtler than raw fear or greed, but just as destructive. The first is myopic loss aversion. This is the tendency for investors to feel the pain of short-term volatility much more acutely if they check their portfolios frequently. Someone who looks at their stock prices every day experiences the ups and downs as a series of painful losses and fleeting gains, which often leads to emotional, short-sighted decisions. Buffett famously says he wouldn't mind if the stock market closed for 10 years after he buys a business. This long-term perspective allows him to completely ignore the day-to-day noise and focus only on the long-term earning power of the businesses he owns. His fortress-like capital structure enables this mindset. He doesn't need the stock market to provide him with liquidity or validation. The second principle is regret aversion. This is the fear of feeling the pain of regret in the future, which can lead to irrational decisions in the present. One of the most common forms of regret aversion in investing is the fear of looking foolish by deviating from the consensus. Holding a large cash position while the market is roaring higher is a perfect example. The investor fears the regret they will feel if the market continues to climb and they miss out. This fear can be so powerful that it causes them to stay invested in an obviously overvalued market, just to avoid the potential for regret. Buffett's fortress-like independence and his internal scorecard make him largely immune to this. He has famously said, "It's better to be approximately right than precisely wrong." He would rather accept the small regret of missing the final leg of a bull market than risk the massive regret of being fully invested during a catastrophic crash. His financial structure supports this psychological strength. To apply this fortress-building concept to your own financial life, you can use a mental model called the permanent capital structure. This is a framework for organizing your finances to maximize resilience and long-term security, just as Berkshire is structured. It has 3 layers. The first layer is your bedrock capital. This is the absolute foundation of your financial life. You must determine the minimum amount of capital you and your family would need to survive a worst-case personal economic scenario, such as losing your primary source of income for an extended period, say 2 years. This is your ultimate emergency fund. This bedrock capital should not be invested in the stock market or any other volatile asset. It must be held in the safest, most liquid forms of cash: high-yield savings accounts, money market funds, and short-term treasury bills. This layer is not for investment, it is for survival. Knowing it is there, untouched and secure, provides the psychological stability to take calculated risks with the rest of your capital. The second layer is to build your float. For a corporation like Berkshire, this is insurance premiums. For an individual, this means creating streams of income that are independent of your primary job and the stock market. This could be rental income from a property, royalties from a creative work, profits from a small side business, or dividend income from a portfolio of stable, cash-generating stocks. The goal is to create a system where cash is flowing into your accounts regularly, replenishing your capital base, and reducing your reliance on a single paycheck. This float is what allows you to transition from being purely a saver to being a true capital allocator. The third layer is to ensure don't speculate. With your bedrock capital secure and your float providing ongoing cash flow, you can now approach your investment portfolio with a new mindset. Its primary purpose is not just to grow, but to ensure the achievement of your long-term financial goals. Every investment decision should be weighed not just on its potential for upside, but on how it strengthens or weakens the overall fortress. This means prioritizing businesses with durable competitive advantages and strong balance sheets over speculative growth stocks. It means ensuring you are adequately diversified. It means viewing your portfolio as a single, integrated system designed for resilience, not just a collection of lottery tickets. This 3-layered approach is how you move from having a simple net worth to having a true fortress balance sheet. The antithesis of the fortress builder is the leveraged to the hilt operator. This is the business owner or investor who believes that cash is an inefficient use of capital and that debt is the key to maximizing returns. They look at a strong balance sheet and see laziness. They believe in using OPM, other people's money, to amplify their gains. In a stable, growing economy, these operators can look like absolute geniuses. Their returns on equity are spectacular because their equity base is so small. They are celebrated in the business press as aggressive, visionary leaders. They operate their businesses with razor-thin cash reserves, believing that every dollar should be deployed into growth projects. They take on large amounts of debt to finance acquisitions or share buybacks. The individual investor counterpart is the person who uses a large margin loan to magnify their stock market bets or takes out a home equity line of credit to invest in speculative assets. Their balance sheets are fragile, precariously balanced on a mountain of liabilities. When the inevitable economic downturn arrives or when credit markets freeze, their world unravels with terrifying speed. A small drop in revenue can be enough to make them unable to service their debt. Their lenders get nervous and may call their loans or refuse to extend new credit. They are forced to sell assets into a weak market to raise cash, destroying value. They have zero financial resilience. They are the first to go bankrupt in a recession. The very leverage that made them look so brilliant on the way up becomes the anchor that drags them to the bottom. They have optimized for the best-case scenario and have completely ignored the possibility of the worst case, a fatal flaw in any long-term strategy for wealth management. The direct financial connection of the fortress approach is clear when you look at Berkshire Hathaway's credit rating. Despite being a massive, complex company, it consistently maintains one of the highest credit ratings in the world, often AA or better, on par with the U.S. government. This is a direct result of its enormous cash position and its low levels of debt. This stellar credit rating is a tangible, powerful financial asset. It means that when Berkshire does need to borrow money, it can do so at incredibly low interest rates, giving it a permanent cost advantage over its more leveraged competitors. It also means that in a crisis, it is seen as the ultimate safe counterparty, which is why Goldman Sachs and General Electric were willing to give it such favorable terms in 2008. They weren't just taking Buffett's money, they were renting his reputation and his balance sheet's credibility. For an individual, building a fortress balance sheet with strong cash reserves and low debt provides a similar, albeit smaller scale, advantage. It leads to a higher personal credit score, which means lower interest rates on mortgages, car loans, and any other form of credit. Over a lifetime, this can save you tens or even hundreds of thousands of dollars. More importantly, it provides you with what finance professionals call solvency. Solvency is not the same as wealth. You can have a high net worth that is tied up in illiquid, volatile assets and still be insolvent if you can't meet your short-term obligations. True financial freedom is not about having the highest possible net worth on paper. It is about having a rock-solid, resilient financial position that gives you the freedom to act on opportunities, withstand shocks, and control your own destiny, regardless of the whims of the market. This is the final and most profound promise of seeing cash not as trash but as the cornerstone of your financial fortress. You have just spent this time re-engineering your entire understanding of the most fundamental asset in your financial life. You have moved beyond the simplistic, dangerous dogma of cash is trash. You now possess the mental model to see cash for what it truly is in the hands of a master. Not a lazy, zero-return asset, but a strategic position of immense power. It is a perpetual call option on future bargains. It is the physical embodiment of patience and discipline. It is the tool that transforms a market crash from a moment of terror into a once-in-a-decade opportunity for wealth creation. You now understand that the goal is not just to be invested, but to be prepared. This knowledge separates you from the 99% who are passively exposed to the market's whims and places you among the select few who are actively positioned to exploit its moments of madness. But what you have just mastered is a single crucial piece of a much larger, interconnected system. Warren Buffett's success is not built on this one idea alone. His strategy for managing cash is inextricably linked to his methods for identifying wonderful businesses, his framework for assessing management quality, and his deep understanding of the psychological tides of market cycles. The principle of optionality is the what. It's the potential energy you store. But its true power is only unleashed when it is combined with the where and the when, knowing with absolute certainty which business to buy when the storm hits, and having the conviction to act decisively. The model you've learned today gives you the ammunition, but it is the next piece of the map that shows you where to aim. The video that is now on your screen is that next piece of the map. It is the critical link that connects the power of cash to the art of execution. It is the bridge between being a prepared opportunist and being a lethal one. While the average investor might stop here, satisfied with this one powerful insight, the journey to becoming a true master capital allocator requires that you continue to build out your mental arsenal. You are not here to collect random tips. You are here to construct a coherent, resilient, and deeply effective system for building lasting wealth. The choice to click is not about watching another video. It is a declaration that you are committed to completing your education, to forging the full network of models that will allow you to navigate any market with clarity and confidence. The next link in the chain is waiting.